Richard Emil Wykoff, 1873 to 1934, was an early 20th century pioneer in the technical approach to studying the stock market. He is considered one of the five titans of technical analysis, along with Dow, Gann, Elliott, and Merrill. According to Wykoff, the market can be understood and anticipated through detailed analysis of supply and demand, which can be ascertained from studying price action, volume and time. An idealized schematic of how he conceptualized the large interest preparation for an execution of bull and bear market. The time to enter long orders is towards the end of the preparation for a price markup or bull market, accumulation of large lines of stock, while the time to initiate short positions is at the end of the preparation for price markdown. The law of supply and demand determines price direction. This principle is central to Wykoff's method of trading and investing. When demand is greater than supply, prices rise, and when supply is greater than demand, prices fall. Divergences between volume and price often signal a change in the direction of a price trend. A successful Wykoff analyst must be able to anticipate and correctly judge the direction and magnitude of the move out of a TR. Fortunately, Wykoff offers time-tested guidelines for identifying and delineating the phases and events within a TR, which, in turn, provide the basis for estimating price targets in the subsequent trend. These concepts are illustrated in the following four schematics, two depicting common variants of accumulation TRS, followed by two examples of distribution TRS. The spring takes price below the low of the TR and then reverses to close within the TR. This action allows large interests to mislead the public about the future trend direction and to acquire additional shares at bargain prices. A spring is often followed by one or more tests. A successful test, indicating that further price increases will follow, typically makes a higher low on lesser volume. A low-volume spring, or a low-volume test of a shakeout, indicates that the stock is likely to be ready to move up, so this is a good time to initiate at least a partial long position. New, higher-level TRS comprising both profit-taking and acquisition of additional shares, reaccumulation, by large operators can occur at any point in phase E. These TRS are sometimes called stepping stones on the way to even higher price targets. Phase A in a distribution TR marks the stopping of the prior uptrend. Up to this point, demand has been dominant, and the first significant evidence of supply entering the market is provided by preliminary supply, SOJ, and the buying climax, BC. These events are usually followed by an automatic reaction, AR, and a secondary test, ST of the BC, often upon diminished volume. The points about Phase B in distribution are similar to those made for Phase B in accumulation, except that the large interests are net sellers of shares as the TR evolves, with the goal of exhausting as much of the remaining demand as possible. This process leaves clues that the supply-demand balance has tilted toward supply instead of demand. Often demand is so weak in a distribution TR that price does not reach the level of the BC or initial ST. In this case, Phase C's test of demand may be represented by a UT of a lower high within the TR. Anyone still in a long position during Phase D is asking for trouble. Phase E depicts the unfolding of the downtrend. The stock leaves the TR and supply is in control. Once TR support is broken on a major sound, this breakdown is often tested with a rally that fails at or near support. This also represents a high probability opportunity to sell short. Modern Wykoff practitioners can utilize the relative strength ratio between a stock and a market proxy to compare points of strength and weakness. In fact, use of the relative strength ratio can more easily eliminate potential inaccuracies due to the existence of different price scales between a stock and its relevant market index. Wykoff developed a uniquely effective method to identify price targets for both long and short trades using point and figure. This method embodies Wykoff's fundamental law of cause and effect. A trading range represents the cause and the subsequent price movement out of the trading range represents the effect.
This is my magazine channel. Thanks for watching. Please subscribe.